Is buying index funds as risky as buying individual stocks? The short answer is no because of diversification, but let me explain. When you buy a share of an S&P 500 index fund, you're buying a small percentage of 500 large US-based companies. If you hold on to that fund throughout your 30-plus year investment timeline, the S&P 500 companies will change, and so will the companies within your fund. It usually takes an overall market correction, like something that we're seeing right now, in order for the S&P 500 to significantly drop. But with that, we have over 100 years worth of data to suggest that on average, the S&P 500 goes up. Compare this with picking individual stocks. If you pick, let's say, 10 companies to invest in throughout a 30-plus year investment timeline, there's nothing to suggest that all 10 of those companies are still going to be around by the time you go to retire. It is really risky to put the fate of your retirement in 10 or even 20 companies. Now, the second part of your question, is this a guaranteed amount of money, and is there a chance that you lose it? It's important to remember that with any return always comes a risk. But you mitigate that risk by, one, diversifying, so maybe don't put all of your investments into an S&P 500 index fund. I have index funds for small cap stocks, growth stocks, value stocks, and international stocks as well. And second, mitigate your risk by your asset allocation. As you inch closer to retirement, a lot of people hold less of a percentage of stocks in their portfolio and a higher percentage of bonds. A good mixture of stocks, bonds, and cash can effectively mitigate a lot of the risk that you see within your portfolio. That was a really simplified explanation of asset allocation, so if you want to learn more, I have a free 20-page intro to investing guide linked in my bio. I hope this helped, and leave any more questions in the comments.